Yeah, it's a very good question. On that point, I think what I was saying to the guys was thinking about what's driven inflation today. So the main things to consider from my perspective, or what I feel have been the main drivers. So it's been supply chain bottlenecks, increased demand for goods and services post-pandemic, geopolitical tensions, obviously one of which being Russia-Ukraine, which has then driven commodities prices, which is then fed through to the likes of things like RPI and CPI in terms of the items that get priced to reflect that. So I think generally speaking, there's a number of things that have driven inflation, and therefore could more have been done to quell it is difficult to say, but I think a lot of those things are sort of like force majeures, like not acts of God, but they're things that really you can't control to an extent. But ways that they could have managed it, I suppose just very quickly, have been increasing supply. So obviously demand drives prices, so increasing supply would have been helpful. Reduced reliance on certain areas, so Russia being one of those in terms of gas. Onshoring, so there's obviously a lot of conversation around like bringing everything back on shore, and once again not being so reliant on external countries. Improve relationships with other major producers, China, India, Latin America. And post-Brexit, obviously a lot of people shifted back to respective countries. So I think sort of the labour market has been a genuine driver of inflation as well, as sort of my 2 pence on it.
I was going to say, I think it's quite interesting just looking at the different sort of countries and how they've reacted to it as well. So if you look at the US, for example, they seem to be faring a bit better than we are at the moment. So they've more aggressively increased their interest rates, and that seems to have worked for them. But then you look at other countries and they're in a lot worse situation as well. So I think it is very specific on where you are, how the economy actually functions, and sort of the backdrop of that. So across Europe, their inflation is still high. In some places, it's even going up. And a lot of it is to do with location at the end of the day, because it's where you get the supply from. Obviously, the oil and gas reliance in the US is not based on Russia. They've got their own supplies, so that's not been a driver for them. Whereas for Europe, and like Germany in particular, it's been one of the major issues that they've had. It's interesting sort of looking at it from that perspective, in that could they have done more? Maybe, but you've got to look at it from a sort of country to country basis. I think you can't sort of paint a broad brush across all the different areas.
Everyone's approached it differently.
I
think Turkey have just gone back into positive rates. I think they're up at like 14%. Inflation's at like 40.
Yeah, they went up. I think it was 6.5%. Last raise they did.
Which is pretty wild, isn't it?
I suppose as a government, if you're looking at the natural shift on the way the UK has been going, I think there should need to be a lot more looking at business investment. So as a country, I suppose we were seen as once a powerhouse. Now I think the UK operates as 4% of the globe. So it's trying to look at, going back to the vanilla of what is the UK good at, because like you say, we were once seen as powerhouses down to oil, gas, but now if you're looking at the UK from a global perspective, what is it that people look at and say the UK is solid? Is it banking? Is it insurance? Is it all the way down to old school minerals? Are we starting to have to look at those? But I think the economy has been kind of exposed to, there is a question mark of what is the UK now good at? And it's going back to that principle from, okay, an economy's point of view, what can we do and what is the government doing? It seems that at the moment there's always been this type of chasing around of governments to say, okay, we should do this, and then quickly all of a sudden, actually we're out of favour. And we can see that, how quickly we've had, 3 prime ministers in the last 12 months, all with a difference of opinion. So I think it starts with a bit more solid leadership and having that and that direction that everybody starts to back.
I suppose the UK could be better at selling itself and know what it's, like you say, knowing what it's good at. But when you have, I suppose, 2 political parties which historically have been polar opposites, which are now much more centrally aligned, but at the same time it's not clear. I wouldn't even, what's the biggest export or what's the biggest export from the UK? Tourism's pretty big.
I would say probably banking services and
banking.
financial services, I'd imagine, but
But that's slipped down the list, isn't it, considerably? But, I think there certainly need to be changes on markets and what draws businesses in to the UK. So obviously they bring jobs, that will then level out that job piece, brings more supply.
And then I suppose that goes back to the inflation point of, okay, well, you need to understand consumer spending overall, because what's going to happen more and more at the moment is as rates go up, consumer spending then decreases, which then has a knock-on impact to go, well, actually businesses are then going to be struggling even further, which then has a knock-on into employment. So there's always going to be that fine balance of how far are people prepared to push before the economy goes back to a state which, like we saw in 2008.
It's a very fine line, and I definitely don't envy those setting the interest rates to decide where that stops, because every time obviously we get a new announcement, every interest rate rise, every inflation report that comes out, they've got to make that big call on, are we doing enough? Have we gone far enough? Is it actually going to tip us the other way? Now obviously we've had the big rise last week. There is anticipation that we could be in a recession by the end of this year now, just based off the back of that rise. And it's, well, how do you get that balance right? You can't see 6-12 months in the future. You don't really know what that impact's going to be, and it takes time, obviously, with people's mortgages changing, with the loan rates changing and everything else. People aren't going to feel that impact for a bit of time, because I think it was something like 80% of people now are on fixed rate mortgages. So there's only going to be, albeit tens of thousands of people, but in the grand scheme of things, it's not very many people it's going to impact on a month-to-month basis. So it does take a long time for it to take hold. So it's almost impossible to say.
It's really difficult. There's no playbook. No. And I think if you look at examples, I know that a lot of people make the example of Volcker in the US, don't they, where he put rates up to 14% really aggressively and then brought it back down, and that squashed demand and inflation came down. But there's a lot of different drivers, isn't there, like Russia, Ukraine, and
absolutely,
so on and so forth. So in answer to that question, possibly, but it's very difficult. It's multifaceted. Is would be the sort of the end, I think, or
the conclusion.
The conclusion on that piece. I think I was looking at some stats this morning, just knowing that we were going to talk to around this question, and I think numbers around outstanding value of residential mortgage loans has reduced, and I think further to what the US faced back in the GFC, so 2008, there's much higher level of scrutiny on lenders. So I don't know what the state of play is in the US, but in the UK. There is a monthly, the FCA and the Prudential Regulation Authority, they have to come to the market every month, they will request from lenders how much money is being lent, what's the LTVs, what is their exposure. So I think there's certainly a much greater level of control on that. And I think with that in mind, naturally that's going to take some risk out of the market, and then I think from a US bank perspective, good example that we all know is obviously like SVB, so Silicon Valley Bank, Credit Suisse, First National, which I think merged with like JP Morgan or Morgan Stanley or someone, but it's
a different problem,
different issues, but it's at the same time I feel like that all feeds into like sentiment in the banking industry, rather whether that's lending or whatever. I
think the systems are very, very different in terms of how they're run. I think the problems of 2008, obviously, generally we know why that happened, and a lot of it was just loose monetary sort of policy, effectively, in terms of they were just lending to anyone and everyone. And obviously now the scrutinisation, a lot has been learned from that. And that there is a lot more checks, a lot more testing, a lot more sort of risk management that goes into actually even before you get to the stage of a mortgage being offered to you. So I think to sort of ability for you to be able to repay that mortgage has become more difficult, in that actually getting it in the first place is harder than it was, which ultimately is no bad thing. But yeah, there is going to be obviously a more pressure on it now, in that there is going to be individuals that are unfortunately going to have to lose their jobs. There are going to be individuals that won't be able to pay those 5% rates once they have to remortgage, and there is going to be pressure on that area of the market. Obviously the government now has sort of realised that. They've put various different sort of rules in place now, where there's going to be, I think it's 12 months repossession clauses and things like that now, so you can't just basically claw it back. But I think from a institution perspective, everyone is in a much stronger position than they may have been 10, 15 years ago, because of everything they have to basically back up and have on their books to be able to facilitate any potential issues with sort of redemptions and things like that.
Yeah, and I think what the issue we're going to see though is, since 2008, a lot of people never experienced the downside of markets, the fact of not being able to afford mortgages. So if we look at the modern sitting professional who might be, say, 35, they've not experienced negative equity within properties, and we're now starting to see people who have become, like, say, accidental landlords that never felt that they were going to have this pain point of can I afford this second property. Like, I'm seeing it alone. If I look at myself, I have a second property which its mortgage rates are going up, but then rent actually isn't going up in line to that, so people are going to get squeezed and squeezed and squeezed. And that's going to be the harder point, I think, because everyone, despite having extra stress tests brought in, people have started to get used to spending in a particular way as well. So yes, maybe back in 2008 people didn't spend as much on having a nice car, say. So now people have got
household debt,
extra debt associated to themselves, and don't have what, I suppose, if we go back to all the principles of what we talk about with clients, is having a solid emergency fund in case of this rainy day predicament that could happen. But a lot of people will push that to one side to be able to get some of these things, so that they can continue to say, look, I have the nice car, the nice house, etc. when it comes to that. And that's going to be something from a housing perspective that I think we're going to see more and more as mortgage rates start to fall out over the next 2, 3, 5 years. That all of a sudden
come back online,
supply is coming, but then that's going to go back to the point of, well, are people going to be able to afford then to get a mortgage? Are they going to be saving in the right way to possibly have the right downside payment, or are they going to actually go back to, actually, is it worth having property with the risks that are associated to it? So in the UK, we are type of an economy, right, that's built off people wanting to have bricks and mortar, where if you look at some countries, it's just the type of
people rent
and all the way through their lives instead. So maybe there might be a natural shift towards that.
I think from a client's perspective, I wouldn't say they don't need to worry. I think you just see the way that banks reacted to all those bits that we've mentioned around Credit Suisse and SVB and so on and so forth. And I think on that basis, what a client can do is obviously make sure that they've got the FSCS protection. I think that was one of the big issues with SVB out in the US, is that they had, I think in the US it's like 150 in terms of the insured coverage.
It's definitely much higher than it is here.
And obviously most of the people that were with them inherently took more risk, because they were, like, obviously startups. So they were all over leveraged towards that. But in the UK, as long as you've got the 85k there, and obviously the FSCS doesn't go kaput, then you're absolutely fine. So
would be in much bigger problems if you weren't getting covered with that FSCS protection from there. So it's that £85,000 limit. Manage that position, and make sure you're just spreading it around and doing it from that perspective. There's no like you say, particular cause for concern. On that side of things. And ultimately, lending has been the cheapest it's ever been, and probably ever will be over the last 10 years. And it's going to be, we are moving into a new normal, basically, I think, going forward, in that the interest rates are going to be 2-3%. That's just what it will be. There will be an adjustment probably in house prices, but as we just mentioned, we're very sort of focused on property as investments, and
it's diversification.
I don't think it's going to change massively. And it also it can be a very good investment.
Yeah, and you'd always advise a client to diversify anyway, and most people are investing in real assets, equities, fixed income, properties, cash, up to the FSCS limit. So in answer to the second part of that question, I would just be advising people of the insurances that are there, safeguarding their assets through obviously real assets being invested within SJP, the banks that hold the cash for us, so State Street, HSBC, Chudleigh rated companies, all typical stuff. But you can't plan for everything, but you can obviously plan to an extent and try and make your position as safe as possible.
Yeah,
that's what I'd say. I think if property prices fall, obviously it gives an increased opportunity to those that are looking to buy. Most of the time people have to sell to buy unless you're a first time buyer, so it's all relative, depending what part of the country you're living in. Up north versus London is obviously it's very different in terms of prices versus real wages. And I would also say that subsequent falling of those property prices normally means that banks will then start, because the banks will be affected by that as well in terms of their exposure to those assets. And then you would expect that the 0%, which I think are available now, 0% deposits on certain properties, depending on your position, that becomes non-existent once again, and you move into a world where it's like 15-20% deposit if they do fall. Because everyone's affected, it's not just the individual that owns it, the bank owns it until it's paid off.
Yeah, absolutely. And I think in terms of the house price positions and what that sort of might look like, particularly for the first time buyer market, obviously there at the moment is a lot of difficulty in that obviously rents have been going up in line with mortgages, and therefore it does continually become harder and harder for people to save that deposit and build that sort of buffer that they might need to put down and pay stamp duty, legal costs, all the various other costs that are involved with sort of moving and everything else. So it's a bit of a double-edged sword in that I don't know if it's going to make it any easier per se, but it might change the shift and the focus on what people might need to look at sort of doing in terms of how they're going to plan to be able to acquire that first property and actually get on that property ladder if that's the way they want to go, of course, from there.
And I suppose they're slightly unsure whether they're going to help people onto the market these days, going, okay, well actually I wasn't getting any return on that money, I would be prepared to help somebody out for X amount of time. So that's going to be another question mark that's brought into the mix. Is money going to be coming from family members to help people out, or is it going to be more self-reliant? And if so, is it then back to the point of, are people going to have to look at 95% or 100% mortgages to be able to do that?
Yeah,
so,
that's a really good point. Yeah, the Bank of Mum and Dad.
Yeah, that's certainly going to be, as we're starting to see more tax changes happen, people who are paying more taxes maybe don't have as much extra money to be able to help people out. So.
Yeah.
Well, the individuals that were lending the money, like Mum and Dad, just using that example, they're equally going to be in a place if they have debt.
Squeezed.
Well, they're all being squeezed. Yeah, cost of living's up, so perhaps it isn't something that's that supports them. But I think, it's will it help people get on the ladder? Unless someone is in a particularly good financial position where they have a very secure role, they've got 20% deposit, they're not selling, yes is the answer. But I think that's probably a very small percentage of people that are first time buyers, perhaps. Unless you're in a professional services role like a lawyer, consultant, investment banking, don't know if that's considered that, but yeah, in those kind of roles where your earnings can reflect those high prices.
Yeah. So I don't know if there is going to be much of a drop, and the reason I say that in terms of the house prices is because people aren't going to try and move as much. Yeah. So when you're paying high mortgage rates, you're not then going to be looking potentially at moving to your next house. You're not going to say right now is the time to upsize because it's going to cost me more. They're all stepping stones, of course, but ultimately you're in a similar position to someone buying a first-time house when you want to sort of do your upgrade. Yes, you're in a slightly better position in that you've got an asset that you can use to leverage and build that sort of next step on, but you're still going to be having to take on that extra £1,000, £2,000 in terms of the mortgage costs, and is that going to be something you want to facilitate when everything is getting more expensive? Maybe not, and we're starting to see that supply sort of constriction happen now, with limited supply, demanding still there. Ultimately, there are still those individuals that are in a fortunate position that can do it. We might not see as big a drop maybe as sort of some people are anticipating potentially, but